All right, let's talk about something that I think is on every investor's mind. How do we stop feeling like we're just gambling in the market and start acting like we have a real plan? Today, we're going to build a system, a repeatable, logical process that you can use to navigate any market condition, so you can actually build wealth that lasts. Let's jump in.
You gotta love Warren Buffett, right? He just has a way of cutting right to the truth. And this quote, it's perfect. Because in a bull market, when every stock is going up, we all feel like geniuses. It's easy. But when that tide goes out, when the market takes a downturn, that's when you find out who had a real strategy and who was just, well, swimming naked and hoping for the best.
And this really gets to that feeling in your gut, doesn't it? That anxiety that so many of us feel. This sense that we're completely powerless, just at the mercy of the market's whims. But what if that wasn't true? What if you could actually build a system to protect yourself, a system that gives you back control? Well, that big, scary threat that keeps us up at night, it actually has a name. It's called systemic risk. And this is not about one company having a bad quarter. No, no. This is the big one. This is the earthquake that shakes the entire foundation, like what we saw in 2008, where almost everything goes down together. So let's break this down because understanding the difference here is absolutely critical. On one hand, you have that systemic risk we just talked about, the whole market meltdown. But on the other hand, you've got non-systemic risk. Think of this like the BP oil spill back in 2010. It was absolutely devastating for BP, for that one company, but it didn't crash the entire stock market. Knowing which type of risk you're dealing with changes everything. And this is where so many investors get it wrong. We're all told to diversify, right? Don't put all your eggs in one basket. But here's the problem. Diversification is like a flu shot. It's great for protecting you against one specific thing, that non-systemic single company risk. But a flu shot isn't going to save you from a massive systemic heart attack. You need a completely different kind of protection for that. So how do we build a fortress that can actually withstand that market-wide storm? Well, that's what we're going to do right now. We're going to walk through the investor's dilemma, introduce a framework called the 4 pillars, and then we're going to break each one down. And finally, we'll put it all together into a routine you can actually use. Okay, we've identified the problem, we know what we're up against, so now let's talk about the solution. It's time to replace all that hope and hype and fear with a repeatable, logical system. Let's introduce the 4 pillars of investing. These are it. These are the 4 legs of the table that will support your entire investment strategy. First, we've got to check the foundation with fundamental analysis. Second, we have to read the direction of the wind with technical analysis. Third, we need to generate cash flow from our assets. And fourth, and maybe most importantly, we need a rock-solid risk management plan. You need all 4 working together. Okay, let's dive into pillar number 1, fundamental strength. Look, you wouldn't buy a house without getting an inspection, right? You check the foundation, the plumbing, the roof. Well, it is the exact same thing with investing. We need to start by looking at the health of the entire economy, and then drill all the way down to one single company. We start with the big picture. You have to know what kind of environment you're investing in. What's the Federal Reserve doing with interest rates? Is the jobs report showing growth or contraction? Is GDP going up or down? These are the massive currents that move the entire ocean of the market, and you want to be sailing with them, not against them. So once we know the overall economic weather is favorable, then we can start looking at individual companies. We use simple financial ratios to figure out if a stock is a good deal or if it's way overpriced. 2 of the best are the PEG ratio and EV to EBITDA. And the key is simple. For these, a lower number is generally better. It means you're not overpaying for that company's growth and earnings. A PEG ratio under 1, for example, is a fantastic sign that you might be getting a bargain. Let's just double-click on EV/EBITDA for a second because it's a real powerhouse. Enterprise value, or EV, is what it would cost to buy the entire company, debt and all. EBITDA is basically its raw profit engine. So when this ratio is low, say under 10, it's telling you that you're getting a whole lot of earning power for the price. It's one of the best ways to spot a genuinely undervalued company. All right, pillar 2, this one is so crucial. Because a company can look absolutely perfect on paper, amazing fundamentals, great value, but the stock price can still go down and down and down. Why? Because fundamentals tell you the theory, but technicals tell you the reality of what's happening right now. This is one of those classic trading quotes that has stood the test of time for a reason. You can have the strongest opinion in the world that a stock is a great buy, but if the actual price is going down every single day, then your opinion doesn't matter. The market is right and you're wrong. The price tells the ultimate truth. So, technical analysis is really just the art of reading the market's collective mind. When you look at a price chart, you are watching a real time battle between buyers and sellers. And all we want to know is who's winning. Is the price making a series of higher highs and higher lows? Well, that's an uptrend. The buyers are in control. Our job is to find those uptrends and ride the wave with them, not try to fight the current. Okay, let's talk about our final two pillars, which are all about our tactical plan. So we found a fundamentally strong company, it's trading at a good value, and its stock is in a clear uptrend. Pillars 1 and 2 are checked. Now, what do we actually do? How do we make money? And more importantly, how do we protect ourselves?
Pillar 3 is an absolute game changer. Most people just buy a stock and hope it goes up. But with this pillar, we can actually generate an income stream from the stocks we own. How? Using strategies like selling covered call options. Think of it like this. You're getting paid to agree to sell your stock at a higher price later on. Someone pays you cash, a premium, right now for that right. If the stock doesn't shoot up past that price, you just... And finally, we've arrived at the most important pillar of all. Seriously, if you ignore this one, none of the others matter. Risk management. You can't predict the market, you can't control it, but you can 100% control yourself. This means deciding before you even enter a trade how much you're willing to risk. It means having a hard stop loss, a price where you get out, no questions asked if the trade goes against you. This is your fire escape plan. It's not optional. It's what keeps a small loss from becoming a devastating one. Okay, so we've got the 4 pillars, we have all the components. Now, let's put them all together into a simple, step-by-step routine that turns all this theory into real-world action. This is how you actually do it. Think of this as a funnel. It's a simple 3-step filtering process. Step 1, we look at the whole market. Is the environment good for investing right now? Step 2, we ask, okay, where is the money flowing? Which sectors are the strongest? And then, and only then, in step 3, do we start hunting for the best individual companies inside those winning sectors? It's all about putting the odds in our favor. And this isn't just a random guess. There are patterns here. For example, during a recession, people still have to buy medicine and keep the lights on, so defensive sectors like healthcare and utilities tend to hold up well. But when the economy is in a full recovery, that's when people are buying new phones and going on vacation, so sectors like technology and consumer discretionary just take off. Understanding this cycle tells you exactly where you should be looking for opportunities. And here it is, the whole system boiled down to a 5-step checklist. This is your pre-flight check before you ever invest a single dollar. 1. Check the market. 2. Find the leading sectors. 3. Scan for fundamentally strong, undervalued companies in those sectors. 4. Pull up the chart and make sure the trend is your friend. And 5. The most critical step of all. Define your cash flow strategy and your exit plan before you ever click buy. So I'll leave you with this one question to think about. When you look at your own portfolio, are you building it based on a logical, repeatable system? Or are you just building it on hope? The choice and the results are entirely up to you.